new AM Best research report has determined that U.S. life annuity writers have increased their mortgage loans for 6 straight years. This includes jumps of more than 8% in 2015 and 2016, which represent 10-year highs. AM Best Associate Director Jason Hopper joins us to discuss the implications behind this trend and some other findings that materialized in this Best Special report on insurers and commercial real estate. Jason, good to see you.
You too, John.
Now, Jason, the report indicates that the majority of the industry's commercial lending takes place in major metropolitan areas. What's behind this?
Well, that is true. Major metropolitan areas tend to have better characteristics in terms of real estate. They have better quality. They typically have better liquidity as well, with the demand for these types of properties being in major metropolitan areas. Along with that, the tenant profile tends to be a little better in terms of creditworthiness and things like that. So insurers don't have to worry about their continuous mortgage payments being made timely and monthly by their occupiers.
Overall, how have these investments performed?
Historically, very well. In general, I don't think mortgage foreclosures and delinquencies have topped more than 1% of holdings for at least the past 10 years. So insurers have been very diligent in their underwriting conservatism, and this asset class has performed very well for them over a number of years and have added some yield as well in today's low interest rate environment.
Are there risks that insurers face when it comes to commercial real estate?
Like any other asset class, there are obviously risks. You could think geographic and property type concentrations. Think coastal properties. Think areas that might experience some catastrophes. You have obviously Houston, Texas just got hit. The Panhandle, Florida just got hit with a bunch of hurricanes. So if your mortgage loan portfolio is highly concentrated in, say, someplace like Miami, that would be much more cause for concern as opposed to having a much more geographically and property type diversified portfolio.
The report indicates that the loan-to-value factor is something that needs to be monitored. What are you seeing there?
That is something that insurers do monitor. In general, insurers tend to have better loan-to-values than, say, banks or other type of lending institutions. And that lends to the fact that insurers tend to be more conservative in their underwriting. One thing we have been seeing is the increased valuations in office buildings and apartments. And we do note that those two property types account for more than half of mortgage holdings held by insurers. So that's obviously something that we are watching that could potentially suppress loan-to-values in the near term. But again, insurers need to maintain their risk management controls within this asset class and investment portfolio strategies in general.
Thanks, Jason.
Thanks, John.
You can find a full copy of the report at ambest.com. And for AM Best TV, I'm John Weber.